am Grace Yabokando from Orbit TVET College. I am offering Applied Accounting Level 4. And today we are going to be dealing with topic number 3 of Level 4 Applied Accounting. Previously we dealt with topic number 2, which was on financial statements. Today we shall deal with balance sheet. I'm sure we did explain the meaning of a financial statement, and today's LO, learning outcome, will be to explain the purpose of the financial statement and then how to prepare the balance sheet and the notes to the balance sheet. Now, the learning outcomes that we are going to do is to explain the concept of financial statements and completing the balance sheet according to the general accepted accounting practice. Looking back, we did the income statement already, which was the financial report, which shows the determination of the business financial performance in terms of income and expenses over a specific period of time, the result of which could be either a loss or a profit. Now, it's important for us to know what the financial period is because all our calculations are based on that financial period. Now, a financial period is a period of 12 consecutive months or periods which form a financial year or a financial period. That is very important for us to determine. For each question, we need to know when did we start the financial year and when did we end the financial year, because our calculations are based within this period. Now, in the balance sheet that we are going to do today, the balance sheet is a financial statement which shows the financial position of the business. Now, when you say financial position, we are talking about in terms of the monetary value of all our assets, our liabilities, and the owner's equity. Now, we must remember that when we say the owner's equity is what the owner has contributed to the business, and the liabilities are the ones which we acquired through loans. Now, the requirements for preparing a balance sheet. First of all, you will need a post-closing trial balance. A post-closing trial balance means that, you remember during the year we do a lot of transactions, of which at the end of the year we have not yet completed recording everything. So all those outstanding recordings which we have not yet done must be done first and all the figures updated. Then we prepare a new trial balance which will be a post-adjustment trial balance. In that post-adjustment trial balance, we have included the nominal accounts, which we use to prepare the income statement. But now, to prepare the balance sheet, we need only the balance sheet section. So we need to close off all the nominal accounts. Then we remain only with the post-closing trial balance, which are only the B accounts, the balance sheet accounts. And those are the ones which we need to prepare the balance sheet. So those are the requirements. To do the balance sheet, we need to have a framework. And this framework is prescribed by the rules of the general accounting practices. Now, we have to indicate the value of all our assets in different categories. Now, I have put here the general framework, but I'll show you on the presentation. The balance sheet, first of all, must have the name of the balance sheet. In this case, we have the balance sheet as at. When you say at, it means that it's prepared on a specific day. Usually it's at the end of the financial period. In this case, it may be 28th of February and in the given year, or it could be the 30th of June in a given year. It depends on the financial period of the business which they are using. So now I am showing you here the elements of the balance sheet. which are prepared according to the accounting equation, because all our assets, we have assets as a result of what the owner has contributed to the business, and some assets were acquired through borrowings. That's why we have got all assets of the business came from the borrowings of the business and the owner's contributions to the business. That's why we are following the accounting equation. We have the first section of the balance sheet is the section for assets. Now, in the assets, we have got the two types of assets. Other assets are fixed assets, meaning that these are assets known as non-current assets, which are used by the business for a period of more than 1 year, more than 12 periods. Now, and have got the financial value to the business. Now, these are categorized in terms of non-current assets, which has got two things in it. We have got the property, plant and equipment part, and we also have financial assets. The financial assets are things like the fixed deposit, the investments of the business. Now, after the non-current assets and the fixed assets, the next category would be the fixed assets are fixed deposits under financial assets, which are the investments of the business, which are going to mature in the period of more than 12 months. If it's less than 12 months, then it cannot be a fixed deposit. We have got current assets, which are assets of the business, which are going to be converted like into cash within the period of 12 months. So it's not more than that, which are things like stock. We have got trade and other receivables or debtors, and then we have cash and cash equivalents. Sometimes students don't understand what we mean by cash equivalents. They know cash. Cash is money in the bank. But when you say cash equivalent, what is it? Cash equivalents are things like checks, which you can use to buy something instead of buying notes and coins. And then the other cash equivalent could be a promissory note. Somebody is, for example, someone is owing somebody else money, and they promise that person that, okay, I'll pay you this money within such a period, and gives him a note. That person can use that note to buy from somebody else to say that, okay, someone is owing me money, this is a note. So instead of me paying money to that one, then you are going to be owing that person. So it can work as if it's cash in that way. So those are the cash equivalents. We have cash and the cash equivalents of the business. So these two sections must be put in the sequence of the liquidity. How difficult is it to convert to cash? So the most difficult one would be non-current assets, then financial assets, because they have a period of more than 1 year. And then you have current assets, which are within 1 year. So please, it's important for us to follow this order of writing the assets. The second, then we have the total assets, which is the fixed deposit, non-current assets, the value, plus the current assets. The total will be our total assets. Now, the second section, which is this part, is our equity and the liabilities. This is the financing section of the balance sheet. How did we acquire these assets? They came from the owner's contributing capital, and it also came from borrowings, which are, so when you add this, the owner's equity plus this one, owner's equity, I'll put OE there, plus our liabilities. These two things must be equal to our assets. This is very important, because when you draw up your balance sheet, the top part of the balance sheet must be equal to the second part of the balance sheet. If it doesn't balance, then it means that there's something wrong that you are doing. Now, when we come to the second part, we have the first one is owner's equity. The owner's equity is the interest the owner has in the business. That is what he has contributed. He's interested, so that he must make a profit out of that. If you have invested something and you leave it there, then you are not doing anything. So you must make sure that you look after your equity so that you must gain your interest. That's why we have got that capital there. Then the non-current liabilities will be long-term loans. For example, you borrow money in order to buy a building where you'll be doing your business. That building, if the loan was used to purchase a building, that loan is called a mortgage bond, okay? Then you can obviously buy vehicles. Now, if you buy a vehicle, it's not going to be a mortgage. A mortgage is specifically for the buying of a building. So all those form part of non-current assets because you are going to be paying them off for a period of more than 1 year. That's why they are non-current. The mortgage bond is that portion of the loan where you buy a building, as I've explained already. Then the current liabilities are things which you acquired through short-term loans. For example, you buy trading stock on credit. You're expected to pay that money back within 1 year. Or you get a bank overdraft. That one, you're expected to pay it back within 1 year. So the current liabilities are liabilities which must be payable within a period of 1 year. So these two will form the bottom section of the balance sheet, which is that one. Now, I want to give an example of how we draw up the balance sheet using figures. Here I have got an example of post-closing trial balance of Mr. Plastic. So what we are required to do, I put it under 2 columns because I wanted the whole thing to fit in one frame. I don't know how I can explain this one. The first portion and the second portion, they are one list, okay? Except that I just tiled them to make 2 so that they can fit in one frame. So all these accounts are all B accounts, which were constructed after closing the nominal accounts. Now, when we are calculating, completing the trial balance, we have got property, plant, and equipment, which are non-current assets. Please, this value must be the carrying value, the present carrying value of the property, plant, and equipment. When you say property, we are talking about things like vehicles, such things, and then the plant would be referring to equipment, the buildings where the business is doing their business. And the equipment includes machinery, furniture in the business, all those things. So all of them must be put in the monetary value of the current value of those things. You know that, for example, you buy vehicles. Vehicles do not stay new forever. They're always losing value through depreciation. So that depreciation must be taken into account when you are drawing up the value of the property, plant, and equipment. For example, from our trial balance, we have got buildings. The value of buildings is 785,000. That's the value of our buildings. But we know that buildings do not depreciate. They don't lose value. Instead, they appreciate value. So in level 4, we don't look at appreciation. So we leave the land and buildings as they are throughout our business years. They don't depreciate, they don't appreciate according to us. So we shall have the value for the plant as it is. We don't change it. It remains at cost price, which is 785,000. This is the carrying value of land and buildings. Plus, now we need the carrying value. If we look at the vehicles, the cost price of vehicles is 245,000. That's the when we bought it. But over the years, it has lost some of the value, which we call accumulated depreciation. So we need to take out that accumulated depreciation from the cost price to get the carrying value of the vehicles. So we shall subtract, here we say plus, then we have 245,000, which is the value for the vehicles, cost price, minus the accumulated depreciation on those vehicles over the years, which is our minus 105. Let me just increase this space. I think I will need it. 105,000. This calculation represents the carrying value for vehicles. Then we must add again the equipment. According to this, the equipment cost price is 375,000. 375,000. We need to remove again from this one the accumulated depreciation to get the carrying value, which is our 75,000. 75,000. So we have the value for our property, plant, and equipment being 1,225,000. Okay? We write the amount in the first column because there could be something else there which we need to add in, that one, and then the total will be there straight with non-current assets. Then we look at the next one, which is our financial assets. The financial assets are the fixed deposits which the business has. Now, if we check on our trial balance, the fixed deposit it matures within 36 months, which means it has a period of more than 12 months. Therefore, we shall look at it as a fixed deposit. So it came from MSC, fixed deposit, MSC Bank. Okay, because we must describe where this fixed deposit is. Now, there's no calculation because it's just a value which we are given, so we don't need to calculate it. We write it as it is, 50,000 again in the first column. Okay? Now, when you are done, you have this, then you add them up to put the answer for non-current assets straight there, which will be 1,275,000. Okay. We are done with our portion for the fixed assets. Now we come to the portion for the current assets. The current assets, we have got stock. Where does stock come from? Stock is things which are available to be sold, which is our trading stock. And we also have consumable stores on hand. So you check on our trial balance, we have got stock, which is our trading stock, which is that one. So we just have to add them up, which is 60,000 plus our 10,000. This one now will come straight. Please, it's important for us to write all these figures in line, because if you miss your line, the way I did, then the whole thing becomes wrong, because it has got wrong descriptions. So you must make sure that each number that you put must be in line with its heading. So you continue calculating like that until you reach the end. When you reach the end, you have got total assets, you will add in this column, and then after you finish calculating all these things according to your balance, to your trial balance, you have the end there. This figure for total assets and this one for total equity and liabilities must be equal. If they are not the same, it means that somewhere where you are doing, you made mistakes. So you need to go back, check where the mistake was. So since we don't have much time left, I will simply show you what it must look like. We have all the calculations on the face of the trial balance, and then we have the total assets being that one. Then we have the bottom section of the trial balance being all these calculations, and the total which is there, the same as the total assets. Please, please, it is so imperative that you know all these details by heart, because when you write exams, they are not going to give you all these details. You must know them yourself, and you must know them in the correct order. That's the framework of the balance sheet. If you don't do this, then be certain that you won't be able to answer questions on the balance sheet properly. Now, take note, the balance sheet is prepared according to the accounting equation, which is owner's equity, which is assets plus assets equals owner's equity plus liabilities. Ensure that you understand and take note of the financial period, because all these calculations which we are going to do here will depend on that period. We cannot do anything outside the period. We cannot do anything after that period. Almost all figures which are displayed on the face of the balance sheet are summarized or calculated in the notes, which we did not do today. In the next lesson when we come, we shall be dealing with the notes to the balance sheet. Because these figures, we don't write the numbers here. We do all these calculations in the notes, which will then, the answers to those notes are the ones which transfer to these columns. For today, we are not going to do the notes, but when we meet next, we shall be dealing with notes, and then how do we transfer those amounts to the notes, to the face of the balance sheet. It is imperative that the sequence and details of the framework of the balance sheet and the notes to the balance sheet are learned so that you are able to construct this one without having to refer, because in the exams you won't have any time to refer. Okay, so this second example is giving you the question, a trial balance, but then you have to do, you see here there are no calculations on the face of the balance sheet because the calculations are done in the notes to the balance sheet. So it's only the answers which are here. No calculations. All calculations are done in the notes, which we shall do next time. Right, before we say our goodbyes, there is a mistake which I made on this one. Please let us fix it before we go. You know, in accounting, it's easy to make mistakes. So when you realize that the mistake has been made, it's very important for you to fix it immediately. Otherwise, once you leave it, you forget about it, then all your figures will be wrong. I said there, the consumable stores on hand is 10,000, which is coming from my trial balance, which is 10,000 according to this one. But now, when I did the memorandum, the memo, which is in the next slide there, I used 14,000 instead of 10,000. So if you go to the PowerPoint, this must be, it appears as 14. It appears as 14,000. That's why here you will see there 74,000. And when you are rubbing, you are erasing things in accounting, you have made a mistake. Please don't use this where you do like this. You only put one stroke only, and then you write on top of that as a correction. It's important to do it like that so that we can see what you erased and the new figure for the sake of auditing. Right, so the next item which I wanted to explain was the trade and other receivables. We have trade debtors. Trade debtors is the debtors control. Remember, debtors control are the sales on credit. Then we must remove from there the provision
for bad debts, because those are things which you are not going to receive. Therefore, our debtors are going to decrease by our provision for bad debts. That's why we have there the debtors control figure, which will be 106,000 minus, it's important for you to decrease it by the provision for bad debts. According to our trial balance is 2,000. You remove that one. Then you are going to have to add in this. Remember, you have paid money for expenses for the following year. That one becomes an asset because somebody is owing you a service or owing you something which you have paid for already. So it's a receivable because you are going to receive the service for next year. So that one must be added in as a receivable, which in this case is 74,000. Plus, you have got, you have worked for someone already, and then that somebody must pay you the money which you have worked for, and you have not yet received it. Maybe you receive it in the following year, which will be income, which is accrued income. So that one must also be included in our receivables. In this case, it is our figure 18,000. When you add this up, then you write there as, I can remove this one, 75,000. Then you write the amount there. Then the cash and cash equivalents, it will be bank. Remember, the bank will be an asset if the balance is a debit balance. If it's a credit balance, it's not going to appear as a cash, It will be an overdraft. So you must check properly in the trial balance that the bank must be a debit balance. Must be a debit balance. In this case, it is a credit balance, which is 43,000. So we cannot put it under cash because it is an overdraft. You come and appear under bank overdraft since the balance is on the credit side of our trial balance. Then here we're only going to add in our petty cash, which is 2,000, and cash float, 2,000 plus our cash float. No? Those two you add up and put the figure there. Then once you are done with all these things, you add up these three figures and put the answer in this column. Then you add that one, this one to get your final amount there. So please, it's important for you to make sure that your bank, when you check, it must be debit balance. Then it's an asset. If it's a credit balance, then it is an overdraft. So don't rush just to write things there. Think about it when you look at the trial balance. So due to the time constraints, I think we shall end there for today. When we meet next time, we are going to deal with how to construct the notes to the balance sheet, then transfer the amounts to the face of the balance sheet. Now, sometimes you find that in the notes, you don't have, they've given you only a few notes. Once you have that, you do those notes. The rest of the calculations, you do them on the face of the balance sheet. Right, I think we shall end there for today. Next time when we meet, we shall deal with our notes to the balance sheet and how to transfer the results from the notes to the face of the balance sheet. Thank you so much.